National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.
On today's show, end of the year tax planning 2011 with CPA Ken Davis.
And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Welcome everyone to the Business Insurance Zone. We're broadcasting live to a nationwide audience of financial professionals from Fountain Hills, Arizona, home of America's largest fountain. And with me today and all this week on our end of the year tax planning special, and as you can see, our Christmas specials this week and next week, Ken Davis. Welcome to the show, Ken.
Hello, Stephen. Good to see you.
Welcome. And not only is Ken a CPA, as we said in the introduction, but Ken is a CLU, a ChFC, a CFP, and an SO. But honestly, let's just break down. A CLU is a
chartered life underwriter.
Okay, and a ChFC is
a chartered financial consultant.
And of course, a CFP
is a certified financial planner.
And CPA
is a certified public accountant.
Well,
almost got me on that one.
I almost got you on that. And you know what, Ken? I felt like I just went through a verbal alphabet soup because I'm just going to say. People say, "Well, what are your credentials, Steve?" Nothing. Okay, I'm just the host.
OJT.
OJT. Yes. Well, listen, we're talking about end of the year planning, and we want to take this whole week to break out opportunities for our producers to really be armed with a few really good ideas that they can go at the last second, not only for their own clients, but also maybe to get a few referrals at the end of the year based on saving other people taxes. And really, we're talking about stuff that's just totally legit under the code. A lot of our producers may not even know half of what we're going to be talking about this whole week.
Well, and the other thing I was hoping we could do today is help them with their own personal business situation as well, Steve.
Oh, I think listen, it's hard to preach the message if you yourself are not participating. So yes, it's true. Some of the things we're talking about today, I'm sure our boss is going to be watching the show to get his own little tidbits for Brokers Alliance.
Well, even better, one of the things we're going to be talking about today will give them an excuse to go out shopping for themselves. Now, how fun is that?
Well, first of all, I love shopping, and right now I just want you to know that if you dread it like I do, it's Amazon.com all the way, delivered to your front door, and you can get it wrapped now.
There you go.
All I do is put from Dad, and I'm done. I love it. This is the way to go. Well, let's talk about, there's a big difference here, and I know we should know this, but we don't. I want to talk about the difference and have Ken pontificate a little bit of the difference between tax deductions and tax credits. Because I kind of see that as, everybody keeps mixing this up.
Well, and it makes a big difference. A tax deduction, let's just use an example. Let's say you had a $1,000 deduction, okay? What happens is that comes down, and it comes down to what they call your taxable income, and then we apply a tax rate against that taxable income. Well, if I reduced my taxable income by $1,000, and my tax rate is 28%, then I save $280 in taxes, okay? Now, a credit is what they call a dollar-for-dollar reduction in tax. So if I had a $1,000 credit in that example, I would actually first compute my taxes and then subtract the $1,000 from the net tax to get net taxes. So $1,000 is worth $1,000 with a credit. No, it's only worth $280 in that particular situation. And some of the nuances there are. People might be in a lower tax bracket for particular, especially with the economy being a little tight. If you're down to the 18 or 20%, then all you save is $180 or $200. With a credit, you get a full $1,000.
Can you combine your tax deductions and your tax credits?
Well, sure. It's just how it flows through the tax return. Your deductions flow through different parts of the tax return. Probably the area most people think of is their itemized deductions, and of course that's subject to certain limitations as well, and then those deductions flow to the front page of the return. And then we have above the line deductions, meaning above adjusted gross income. Those are deductions that fall right on the front page of the return, and those are things like IRA contributions and stuff like that.
Let's stay on page 1 of the 1040
Okay.
for the holy grail of Uncle Sam. Okay, I want to always say that adjusted gross income. We all pretty are. I think everybody has a fair assumption that everybody knows what gross income is. My all-in. What did I take in revenue? It could be from different sources. It could be from earned income. It could be from maybe savings, interest at a bank. It could be maybe my mutual fund profits or losses. There's a lot of things to be mixed up there. Talk a little bit about how do I get to AGI? This
Well-
adjusted gross income.
Well, the easiest way for listeners to follow along on something like that is to actually just go to irs.gov and pull up a 1040. And on the front page, you'll see gross income comes at the top of the page, and there's a number of adjustments that go all the way down the page. And those are your deductions or additional income. And then you come at the very bottom of the front page is adjusted gross income, or AGI as we call it. And there's also other schedules like your Schedule C, which is where you report your business income. You can have income and deductions on that too, and you come up with a net number, and that flows to the front page.
And that flows to the front page. When I'm thinking of credits, I think there's a myriad of federal and state tax credits.
Correct.
Now, I've always been curious about, can you double dip? Can I take federal credits, use them for state due, or no, I have to use federal credits for federal income tax and state tax credits for state credit programs?
Well, and the answer to that is there's actually both. I mean, there are federal credits, there are state credits. There's a relationship between the federal income tax and the state income tax, but they don't always sync up. And sometimes when the federal government makes changes, there's a lot of activity and concern about what impact that has on the state in terms of their ability to generate revenue. Way too complex and too detailed to be getting it today, but definitely there is that relationship. And sometimes you may want to take like the standard deduction on your federal income tax return, but you may want to take your itemized medical deductions on your state.
So there's really some strategic issues here.
Sure.
On your Fed and state income tax to measure what you think is going to be the best overall net spendable, or what I get to keep, I guess, is what I'm looking for.
And the main thing here is that these rules, the crazy thing about the Internal Revenue Code is that you have your general rule, and then you have your exceptions to the general rule, and the exceptions to the exceptions to the exceptions. I mean, it's pretty crazy sometimes when you start digging deep into the Internal Revenue Code. It's enough to drive you crazy. So, we want to make sure our listeners know that they are to seek their own tax counsel, and not just to take ideas they hear on the radio show and think they know the answer. They really have to go run it through.
Well, one of the things that I think you're an anomaly, not besides your credentials, which are very oriented to financial planning, oriented to life insurance. I think you have a very big view as a CPA on the use of all kinds of insurance products, deductions for those insurance products, whether they can or cannot be made, but a bigger view, a global view, and that's why you're on the show, because our producers want to always use a tactic, a strategy to get in front of other clients. And what we're doing with the end of year planning show is we're trying to arm them with a few ideas, concepts that they could send out in a quick email. Hey, listen, don't forget to do something generic, like we're tweeting and blogging all this month. Don't forget, end of the year tax planning, end of the year charitable giving, just saying it to the client. He may call you back and say, like we've had some response to our tweets and blogs. Hey, what's out there? Anything new I need to know?
Well, and that brings up some interesting points. I consider myself kind of a bridge between the CPA world and the financial services world. And too often, CPAs have blinders on and see the world from tax effects. An attorney sees legal effects. An insurance guy sees their insurance, and a stock brokerage, wealth manager type guy will see it from investments. And frequently there's things that drop through the crack. And one of the things I try to do is bridge those two gaps. In fact, one of the seminars I did for the CPA Society down for their Tucson launch was, and maybe we'll do a show on this at another time, is the reduction of the taxation of Social Security income in retirement years. And there's some things that you can do, and it's interesting that the insurance people aren't trained to do that, and the CPAs aren't trained to do it, and by combining those two together, we fill up that crack, and we actually help people with ideas that aren't so obvious.
Now, I know you were the former president of the local chapter.
Right.
You've taught, and believe it or not, this is kind of, I find it fascinating. Ken's gotten away with, I could teach this, but they would get that. I'm an insurance person. But Ken actually teaches CPAs how life insurance and annuity works in a huge, I think it's 8-hour course.
Yeah, and it's interesting, their perspective is their clients don't know, but frequently CPAs really know very little about insurance. And their standard response frequently is buy term, invest the difference. And of course we know that sometimes that's right and sometimes it's not. And in changing their perspective or their perception of what's going on, I teach them, I said, first and foremost, understand life insurance is nothing more than a tool. It's neither evil or not great. It's just a tool, and it's how it's used. And so the CPAs that come to the seminars want to know the inside skinny. They want to know how how these things are designed, what's going on. They don't want to be sold anything. They just want to understand the insides of what goes on.
Well, don't they ever question you about going to the dark side? I mean, this isn't like a CPA going to the life insurance. This is kind of like, Anakin Skywalker becoming Darth Vader. I mean, you know what I'm saying?
Well, yeah, and in fact, the first time I taught that 8-hour course, I was a bit nervous because these are my very technical peers. I mean, these are not, Joe Blow off the street. These guys are pretty sharp. And so I was thinking, oh my gosh, I'm going to have to be really on top of it. And it's kind of funny. We know that we love our CPAs. They have these non-emotive, non-emotional, stone-faced type things, and that's just the way they process. And so this is happening in the audience, right? And so I'm not getting a whole lot of feedback until we get to buy term, invest the difference, okay? And then suddenly they're looking forward and they're getting anxious and they're ready to pounce, right? I mean, they're getting really emotional about this thing. And I knew that would happen. And of course, the question is, well, Ken, should you buy term, invest the difference, or cash value? And I said, I knew that was coming, and I just kind of paused and laughed. And then we just went back to CPA speak, which is we run the internal rate of return calculations in the column that we don't frequently see on illustrations. But they relate to the IRR. They understand that makes sense for them. It's number crunching. Suddenly, they're in the world. And at the end of the seminar, one of the guys that was just ready to pounce walks up to me and says, gee, Ken, I've never really understood this. I'm not sure I fully trusted the insurance guys that I worked with. But I think I finally understand this and found somebody I can relate to. So you just have to take our information and our world and turn it into their language, which is numbers.
Yeah, and I think, you being an ambassador, you said you're a liaison, kind of like an ambassador between the two worlds. I think I want to encourage, one of the reasons why we have you on, and we're going to have you on especially next year for all the things we're going to be talking about, it's really that you understand both sides of not only the 1040 balance sheet issues as a CPA, but as a certified financial planner and a charter life underwriter, you have a pretty good breadth knowledge of insurance products, how they work, the mechanics of it, and I find that to be an anomalous issue because most CPAs, as you said earlier, really don't know our business, and so you're kind of a strange hybrid here. Right?
Are you trying to say I'm strange, Steve?
I was going to say something else, but I didn't want to get bleeped on my own show again. So, Well, when I'm looking at all this is the time that I want our producers to really think through all the options that we're going to talk about. The difference between deductions, the difference between credits, how to use it, and when you are the person that's coming to your client with this kind of information, that starts to put you in the put you up in the higher ranking of a fiduciary, an advisory position. And you can remember, there's so many things we're going to talk about on the second half because we have to go through all these ideas. And when you see it, this is all out on the internet, but what we've done is we're condensing it for you. You're listening to the Business Insurance Zone, the talk show that uses insurance in your practice. You can email me at my email address, thebiz@brokersalliance.com, or just call me toll-free 1-800-290-7226, extension 147. Ken and I will be right back after a word from one of our premier providers of guaranteed term and guaranteed UL, Legal General America.
Banner Life Insurance Company and its subsidiary, William Penn Life Insurance Company of New York, comprise the Legal and General America companies, part of the International Legal and General Group, one of the largest insurance companies in the world. Now, Legal and General America is one of the top-rated insurance companies in America, with one of the strongest financial balance sheet among its peers. Legal and General America is a major player in guaranteed term and guaranteed universal life, and consistently ranks among the best carriers in almost every product spreadsheet. Legal and General America's product line of guaranteed universal life endows at the maturity date, while most carriers' cash values just zero out. You know the reputation of Banner? Now know the value of LGA, Legal and General America. The power to protect, the power to preserve, the power to serve their policyholders. That's Legal and General America.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant, your host, financial color commentator, insurance columnist, and interviewer extraordinaire. And remember, before moving forward with anything we talk about on the show, especially today's show, Don't forget to consult with your CPA, your attorney, and your broker-dealer compliance department. Although, Ken, you're my CPA, so I'm consulting with you. Hey, you can call me toll-free, 1-800-290-7226, extension 147, for any questions or quotes you have on life insurance, annuities, LTC, DI, and group pension plans. Hey, it's not what I know, it's who I know, and that's why I have Ken Davis on my show today. Ken, CLU, ChFC, CFP, and CPA. Wow, talk about the alphabet soup of the fiduciary. I mean, I feel like I just went through my old alphabet cereal. Did you remember that?
Oh, yeah.
Oh, back in the day, you could pour it, and then we'd never eat it because we'd be playing with it. You know, I love that stuff. Well, we're talking about end-of-the-year planning 2011, and that means that you have about a couple of weeks to go here on these plans, and then we're going to have to change. We'll have to take the show down because it won't be really germane. Who knows what it's going to be in 2012 and 2013 with the new administration.
Absolutely.
I mean, that could change the map, and I think it is going to change. And there's so many things going on. But for 2012, the clock is still ticking. And I got to say, because we're doing a Christmas-type special, a holiday special, I want to keep everybody informed that, you know, I just found out that Uncle Sam is the Grinch. I just found that out. I was looking at the Christmas Carol starring Uncle Sam as the Grinch, Tiny Tim as the American taxpayer. You know, you know what I'm saying? Just
Scrooge and Tiny Tim.
Scrooge. Yeah. I'm just thinking about, you know, I want to shut down Uncle Sam, Ebenezer, and the Grinch. That's my goal on these shows this week. Now, we've been talking again at the first half. We talked about tax deductions and tax credits.
Right.
I assume that we all got in the first half, and this is a summary statement, if I don't have any taxes due, credits are worthless to me.
That's true.
I actually have to owe it. But now, Ken, here's a question that I get all the time.
But wait a minute, Steve.
Wait a minute.
There are certain credits that are refundable.
So even if I didn't know, give me an example of a refundable.
For people who are kind of hurting, there's the earned income credit, and that's designed to take care of people like that, and it's designed to get some cash back in their pocket.
Now, I'm glad we kind of have these things, but I have to say, if I understood the debt clock, we're over $15 trillion in debt. The last time I saw this, it's like the clock is ticking. And on top of that idea, I've noticed that half of America doesn't pay any federal tax.
Yeah. That's right.
So, I mean, I'm kind of starting to get, you know, when they talk about the 1% versus the 99%, when they talk about Occupy Wall Street, my thing is, what's fair? Well, first of all, half of America is not paying any taxes. How fair is that?
Well, and I get concerned about that too, because then those people that aren't paying any taxes don't ever want to pay any tax. I understand that. If I were in their situation, I would too. But that ultimately means you pit these voters against each other, and it's just I don't particularly care.
It's tough. Well, when we talk about credits and trying to figure out strategic issues like earned income, whatever, when we're looking at tax credits versus tax deductions, it's kind of like we want to get a list. I kind of like to do mine by listing. I like to list all my deductions that's available as an itemizer. Then I'm looking at all my credits, federal and state.
Right.
Okay, I want to list them out and see which ones are apropos to me. Now, Ken, when I'm thinking about that, and remember, for each of your individual states, or if you're watching the show, you're going to have to check on your own state. But if on federal, we have a list, and if you want to call, say, Steve, where's the list? I have a huge list. It's right off the IRS site. You could get it at www.irs.gov.
Right.
Or if you want to call me, I'll be happy to send it to you. That's my address, thebiz@brokersalliance.com, or if you want to call for it, it's 1-800-290-7226, extension 147, and I'll send it to you. I want you to be fully armed so you walk through the line. Now, one thing about CPAs, now, it's a Mythbuster question. I mean, we sit down,
nice.
we sit down and we're genuflecting at the Society of CPAs, which I've taught for, and I love these guys. But I don't really see them as proactive. I mean, I don't see them sending out lists of itemized deductions and itemized tax credits so that the clients go, oh, I need to think about this end-of-the-year tax planning. I need to start cutting some checks here.
Actually, I would generally agree that sometimes they're not as proactive in terms of year-end tax planning as they should be. However, most of them will send out an annual questionnaire. So that is your list. That basically is asking for the information that they're going to need to fill out the return. And then they also, in the list, or questionnaire, will show them what their items were last year, prompting you to put them on the return. And then they compare the two to make sure that they're not missing anything. So in a way, there are lists. But what's interesting, there's a lot of things that fall off the radar screen. For instance, life insurance and annuities never show up on the radar screen. Why? There's no current taxation, right? And there's no 1099s for them. The only time they see them is when something happens where they liquidate and suddenly they've created a taxable event. So the CPAs have been in the dark. So quite frankly, I'd like to see the CPAs start to gather information about annuities and life insurance because
and distributions of the annuities as well.
Well, sure, and because ultimately, if the client's already distributed, it's too late to do any of the planning that's necessary to take care of that.
I'm curious because I think this way. I know you think this way. We have a homogenized approach, an integrated approach, that certain items cause additional taxation that a lot of people are not aware of. I am always trying to manage in my head. If I take this gain of capital gains and I celebrate my 15% tax bracket, but I'm also a retiree taking Social Security. And Ken, I've heard you speak on this, and I didn't want to get into this, but now that I brought it up, I might as well. This whole thing called the cap trap, the capital gains trap. I mean, I'm telling you, there are people out there, 90% of our producers don't know about this, and I think it's a huge issue because it's always celebrated, capital gains at 15%, I'm not paying any ordinary income tax on that, that's the better deal.
Well, and it's an interesting point, and it was so nuanced that I didn't really think about it until I was studying to do this training on reduction of taxation of Social Security income. And what it is that while you get a 15% tax rate on your long-term capital gains, the problem is that the full capital gain, let's say that you had a $10,000 capital gain long-term, that's going to flow to the front page. We were talking about this earlier. You have your income comes in on the front page, and then certain adjustments, and you come to adjusted gross income. Well, why that's important is the taxation of Social Security, whether it is taxable at all, or 50% taxable, or 85% taxable, is based on that number at the bottom of the front page called AGI. And then they modify it some more and add some things to it. Well, your capital gain flows through that front page, and it is included in the adjusted gross income.
Well, now let's just walk through this because I want to make sure I got the mechanics right. So I'm celebrating the fact that I'm only paying $1,500 in your example of $10,000 capital gain. But for Social Security purposes for retirees who are playing in that capital gain arena, the full $10,000 flows over there as actual income that has to pass that test of whether the Social Security is going to get taxed or not. Am I getting that right?
Right. So the $10,000 is included in the AGI number, which will impact whether or not the taxation of Social Security is.
Okay, so
is
if
made.
I got taxation on Social Security, which is taxed at the ordinary income tax rate,
That's right.
then my actual 15% capital gain is triggering an ordinary income tax event I may not have had on any other distribution.
Yeah, it may trigger it or may not.
Right.
It
We don't
depends
know.
upon
We
whether
don't
it's
know.
large enough. And a simple way to know if it is triggering on your own particular return, and you might even our agents may ask their clients to bring in their tax return. Line 20B will show the portion of Social Security that's taxable. And if there is a substantial number on that, there's some planning that can be done.
Is that second page?
No, that's
1040 or
front page.
Okay,
20B is front page.
Okay, so they look at 20B, they see that on the front page, and what are they looking for in that number?
Well, either 20B is 0 or there's some number in it.
All right, now there's some number.
I'm going to say if it's 1,000 or 2,000 or more, there's some planning that can be done potentially that will reduce the income that flows down through gross income. And now we're starting to get into actually we could have a whole week show on this topic. But I think the point you're trying to make is that some of the things that we do impact and what seems to be obvious of a 15% tax rate when we're making decisions. I'm going to invest in capital assets because I'm going to get a capital gains tax. Well, it isn't quite that simple, and then we're going to talk probably a little bit later about alternative minimum tax, which is an entirely different tax calculation. So there's a lot of moving parts, and unfortunately, there was a time back in the 70s, gosh, I'm dating myself, when people would call us and say, if I buy this, if I do that, what is the impact of my taxes? And back then, we could pretty much do it in our head and answer like that. But today it's like, let me pull out my tax projection software and put the numbers in and have all these moving parts to see what drops out of the bottom of this silly thing.
It's just convoluted to be sure.
It's crazy.
And that's one of the reasons why we want you to do end of the year tax. All this week we're going to be talking about a lot of these concepts because we want to pay the least amount of taxes legally under the code. We want to take home the most amount of money. Listen, if you have a huge credit card Christmas holiday bill, my recommendation is if you just would do a little tax planning, you could probably pay for all this and more.
Well, yeah, I mean, there are things that you can do to reduce your taxation, and you can do some things before year end, and that's going to be part of the rest of our show the rest of this week as well.
I have to say, you brought up the evil tax that I hate the most right now. I mean, there's a few that, I hate them all, but this one I have a special despicable feeling for, and that is the alternative minimum tax. Now, we have people, I know the original reason they did this, correct me if I'm wrong, was to catch all the great little deductions people were getting by using preference items and trying to, manipulate their taxes so they could keep it down to zero. And the government finally stepped in years ago and said, well, we got to have something minimum to pay. You can't just pay nothing.
Well, that's right. I mean, there's smart people who employ smart people, and
No, let's get this right. Smart people are employing evil CPAs. That's what's going on.
So why are we evil? We're good because we help you find deductions, Steve. I would take exception with it.
I think the whole alternative minimum tax.
But we're not creating that. The IRS is doing that.
Wait a minute, time out. It's my show. The AMT, the alternative minimum tax, was created because guys like you are so crafty.
That's right.
That's right.
Well,
So
that's
let's get
true.
that.
Okay, so it's all my fault. I get it.
Okay, and you shouldn't be voting Democratic ever again just because of that issue alone. But I'm just saying, okay.
Well, you're right. The alternative minimum tax, it's kind of hard to get your brain wrapped around, but it's actually pretty simple. And the fact is, you've got your regular calculation, then you have your AMT calculation,
we're gonna have to
and you
say
pay
it
the
again.
highest of the two.
Well, we'll catch it tomorrow because we're on. We got to go on all this week. Hey, remember you can catch this show and all our shows and download our show in HD 1080p on our on-demand video section right at www.brokersalliance.com, right on our homepage and on our social networks: YouTube, Vimeo, Facebook, LinkedIn, and Twitter. This is Steve Savant. You've been listening to the Business Insurance Zone with my good friend Ken Davis. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
The National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.